Hello everybody, welcome back to the classroom. How are you guys doing? So today what we are going to talk about is financial performance analysis. See, if I talk about performance, so performance is not like that if a student is over there, he or she has just passed his or her examinations, so that means they are successful. No. Performance, if I talk about a particular industry, it does not mean only from the technical aspects, only from the production aspects. So what we are going to find out, we are going to find out that how we are going to analyze the financial performance. The students who are good in accounts, who know about, they have done their financial management, they have done their accounts part very effectively. For them, this class is going to be very easy. Right. So first of all, if I talk about financial performance, that means financial performance analysis means analyzing financial statements. Now, what is this financial statement? Financial statement includes three things mainly. The very first is balance sheet, that includes profit and loss account, and after that at the end it includes cash flow statement. Analyzing these three parts is all about the financial performance analysis. And looking at the balance sheet of a company or profit and loss account of the company and cash flow of the company, one can easily find out that how the company is performing as compared to last year, right? As compared to last year. So now what we are going to cover, okay. Sir, what is now? Let us go into some few details, the very basic ones. Balance sheet is going to tell us about that how much is our worth in asset and how much are our liabilities. The relation between assets and liabilities is governed by particularly you can say indicated, or you can say mentioned in balance sheet. When it comes to profit and loss account, they clearly mention that what are the various expenses which we have incurred and how, but what about income. And apart from that, the next is cash flow statement, which straight away talks about the inflow of money and the outflow of money in any company, from where the cash is coming and what are going to be what are particularly our outflows. But there comes one more question, that whenever I talk about a particular analysis, or we are going to talk about the balance sheet can only show you the financial performance at a point of time, because it cannot show you being like at a point of time, like being the balance sheet is for the year ended like 2020 2021. So that means it is going to show you the figures at 13/03/2021. It is going to be the performance at a particular given time. Right, getting my point? So balance sheet is going to tell you that yes, at this point of time we have this much of liabilities, we have these assets, and these are particularly our parameters. So this is all about what our balance sheet is going to tell you. Same goes with the profit and loss account. They are going to tell you at this point of time throughout the year we have earned this much profit. Right? If I tell you that we need financial performance of a firm over a period given of time, then how it is going to work, and at a given point of time, then in this situation how things are going to work. Getting my point? Are you able to understand whatever I am telling you guys? Right? Everything is written over there, you guys can study, and apart from that you guys can make your own notes in your own style. But do remember, the presentation over here in such theoretical aspects is hardly going to matter. Now moving ahead, so okay. So financial statement analysis is all about using these financial statements, where you are going to analyze, you are going to collect data, and after that you are going to ensure that yes, proper accounting procedures have been followed, and at the end we are going to talk about that yes, this is our analysis. So the term financial statements generally refers to three basic elements: balance sheet, income statement, that means profit and loss account, and cash flow statement. Whatever I have shown you over there, that means I have written over there, the same is elaborated over here in the book itself. So financial position of a firm at a given point of time, right? So it is a summary of firm's financial position on a given date that shows total asset is equal to liabilities and owner's equity, or you can call it as shareholders funds. That how much money shareholders funds are particularly, definitely you guys must be aware of that. If I talk about balance sheet, you have your liabilities on this end. You are going to write your liabilities. Over and above that, you are going to write your share capital. In the share capital, that means the shareholder fund or the owner's equity. And over here, we are going to have assets which are going to be further divided into two parts. That is going to be current asset and fixed asset. Apart from that, moving ahead, the next and very important part is going to be your income statement. That means from where we are going to find out that what is going to be our performance over a period of time. Throughout the year, how much money you have, earned, what is your profit. Throughout the year, how much were your revenues, how much was your expenses over a specific point of time. Right, it is all about, and at the end, if I talk about this profit and loss account, this profit and loss account is going to mention all the expenses over there, right? Debit all the expenses and credit all the incomes and gains. So what you are going to do, each and every expense which has taken place throughout the year, throughout over a period of time. So profit and loss account is for a period of time, right? We are going to mention each and every income along with the notes that what kind of income we have on. So it is talking about total year, whereas the balance sheet straight away talks about at a point of time we have this much assets. At a point of time, on 31/30/2021, we have these assets. So this is all about balance sheet gives you a prediction of a particular point of time. But whereas if I talk about profit and loss account, they straight away they will tell you about a period, about over a specific period. That during the last year, how much income was there, how much expenses were there. See, over there you will be getting your profit, net profit, and over there if any figure comes, that is going to be your loss. Okay, apart from that, moving at the third and again a vital part of financial statement is known as cash flow statements. Despite apart from that, there are certain companies which are being like small companies or small organizations. They may need not to prepare those cash flow statements, but it's okay. A lot of people are doing this, and cash flow statement can be prepared by two methods, right? The one is going to be like direct method. Direct method is very easy as compared to being like indirect method, right? So over there, indirect method, what we are going to do straight away, we are going to talk about the receipts and payments, and in indirect method, we are going to increase the liabilities and non-cash assets to profit and loss, right? So direct method, do let me know if you guys don't know that what is a cash flow statement. Although I'm expecting that everybody is aware of balance sheet, profit and loss account, and cash flow statement, right? So indirect, particularly if I talk about direct method, is much easy, right? Much easy, and it is much informative. If I talk about any company, let us say being like out of 100, mostly until unless it is specified in law that we are going to use the indirect method, or if I talk about any other act being like FEMA or the specified industry specific act being like Electricity Act or your SBI Act, which applies only on State Bank of India, Banking Regulation Act, which applies on all the banks, Insurance Act. Until unless they are going to specify that you are going to follow the indirect method, then only the indirect method of cash flow statement is going to be followed, otherwise not. Okay, moving ahead, my dear students. Now, next is what we have. Okay, so as we guys know that really very well, that every company is looking forward for modernization, or you can say expansion and diversification. Modernization, that means you are going to modernize your products. We cannot, at this point of time, we cannot use the products which were being used over there in 1990s or being like in 20th century. We need to modernize our products at each and every point of time. Everybody is looking forward for expansion. Everybody is looking forward for expansion. Everybody is looking forward to enter into new markets, into new technologies and into new products. Just like I am over there in SPMBV, that is my expansion. And apart from that, moving ahead, my dear students, next is all about diversification. What is diversification? Diversification means adopting a different line of business. Just like I'm over here in this academics, and apart from that, I do have a business of fruits, I say. So that, what is that? That is a diversification. Diversification, why that has been done? Because maybe in future, what we are going to face being like, there's a crisis in academics, then how I'm going to survive? At least I'm getting some revenue from that fruits, or you can say vegetables business which I'm running, right? So that is all about diversification. So in just to have two lines of businesses in order to reduce risk. So that's why people opt for diversifications. So if I talk about the next part, see, okay, from where we can get money? Sir, from bank. Oh my God. Let us say you are running a particular business and you need funds. When and how those funds can be arranged? So those funds can be arranged from like bank. Okay, that means bank loans that may be long term, that may be short term. Apart from that, you can issue shares, you can issue deposits, you can issue debentures, right? Equity shares, preference shares, that all depends upon you guys. So, I mean, see, everybody needs funds. If I'm looking forward to expand my business, that is not possible. If I'm looking forward to for diversification, modernization, for everything, I would be needing funds. The very prima facie part is being like that people go for loan from banks. So, the planning, the source plan, from where the funds are going to come, we need to plan that first. At a particular point of time, nobody is going to be there that yes, here I give you money, you can start business from tomorrow. No. So whenever we are planning for something, we need to plan for the sources of funds. The very first is share issue. Next is public deposit, that includes the debentures part and the bank loans. So if we are going to start being like, just like you guys must be preparing, whenever you are looking forward that yes, we are going to plan a trip. So we are going to plan a budget first. Just like that, if I'm looking forward to enter into a new business, or I want to have a startup which is going to look after baby products are there, men's products are there, and women's are there. Apart from that, I'm looking forward for somebody who is going to help me with my shoe wash part. See, what I have an idea in my mind that I'll be I'm going to have a startup. I'm going to have a company, and that will be a startup which will be looking after the shoes. Which people are purchasing very expensive shoes these days. So what we will be doing we will be polishing them, right? We will be repairing them in case that is required, and we will be washing them in case if there is any kind of sport shoes or anything like that. We have canvas, we have sneakers, a lot of varieties are over there, and people generally feel shy washing them, and there are a lot of things which cannot be washed, just like leather shoes. So what I'm going to do, I'm going to pick up the cobbler part, and we are going to make it like at a particular level. We are going to make it online. So that is my idea. If this kind of an idea is there in my mind, then I would be needing funds. From where we are going to get funds? So that is all about the cash flow projections. That can be being like from bank, that can be being like from issuing shares or inviting public deposits. And whenever I'm going to get any kind of shares, so let us say if I tell you that yes, we have issued shares. If we have issued shares, that means we need not to return money. If we have issued debentures, we have issued deposits, or we have been like we have certain kind of bank loans, that means we have to refund money. Over here, issuing. Over there, in shares, my ownership is going to be compromised, but whereas inviting any kind of loan or any kind of debt, my ownership won't get compromised over there. So why we are going to use these cash flow projections? Because they are very much helpful. First of all, you are going to elaborate being like that how much is going to be my project cost, and if I'm inviting shares, that what is the exact value of my shares, right? Moving ahead. Now, everybody must be aware of the discounting series of future net cash flows. That means if somebody tells me that I'm going to give you like 20 crore rupees in 2050, right? If you give me like 5 lakh rupees every year, just give me 5 lakh rupees every year, and in 2050, I am going to give you 50 crore rupees. So first of all, I'm going to calculate that how much is the worth of those 50 crore rupees which will be given to me in the year 2050. What is the worth of that money right now? So that is something which is ascertained, which is determined by discounting cash flows. Okay. After that, we are going to get the present value, and we are going to compare that present value with that discounted value. Very simple. That means the value of the investment. So we'll be getting a present value, and then we are going to compare it with the investment. Just like, you must have covered that joke in which call center representative is going to call us, sir, if you give us 20,000 rupees per month, after 30 years, we are going to 1 crore rupees. We are going to pay you 1 crore rupees. I told him that why don't you give me 1 crore rupees right now? I will pay you 20,000 rupees till you are alive. He was shocked, man. Oh my God. I told him that the scheme is very nice. You are giving it back being like for after 30 years, na? After 30 years, I will give you your money back and I will give you 20,000 rupees per month. So he was being like that. Okay, so such things were like that. The call center representative shocked and teacher rocked. ठीक है, तो अब what is going to be there next? So next is all about that I am going to compare the 50 crore rupees he is going to give me in 2050 with the present value of that investment today. That ठीक है भैया, it's okay, I am going to invest with you guys being like on 20 lakh rupees every year or 5 lakh rupees every year, whatever is going to be the situation, and whatever the investment which I'll be getting in future, I'm going to have the present value over there today, and I'm going to calculate that how much money they are giving me. Okay, right? So then we are going to PV is compared with investment. That is something which we are doing already in our cash flow system. So, and apart from that, and after that, what we are going to find out that how much return I'm getting over there in that investment. Let us say I'm contributing being like 20 lakh rupees every year, and in 2050 he will give me 20 crore rupees. 20 lakh rupees every year, and in 2050 he will give me 20 crore rupees. So that means it's very simple. It's very simple that how much is going to be my rate of return, and that is something which is straight away determined, which is calculated internal rate of return, and after that I'm going to calculate this with the normal rate of return on the investment. Whatever is going to be favorable, after that we are going to move accordingly. Okay, right? So over here, if I talk about this is going to be your phenomena, T is submission, T is going to be your time period, and R is going to be your discounted at it. That means you are going to take the internal rate, and after that we are going to discount it. Okay. If you are getting your R, see, there are two R's, R and R. I'm sorry. Now, so this R means the internal rate of return. Internal rate of return, that means the expected rate of return which I am getting after discounting that investment, and this R is going to be my normal rate of return. Normal rate of return. So let us say that if after doing the proper discounting I am getting the return over there being like 12% per annum, this is going to be my return. I said it's okay, perfectly fine. And if my normal rate of return turns out to be 10, that means this is favorable. This is favorable. I mean the internal rate of return. It's rate of return. That is good. That means it is favorable. But if this is the normal rate of return is 15% and you are giving me 12%, why should I invest with you? I'm not going to invest with you because normally the rate of return which is available in the market, it is much higher than the internal rate of return. Okay, got it. Moving ahead, sir. Talking about the next part. See. And this is going to be the phenomena, this is going to be the formula, that how mathematical expression, that how we are going to discount the internal rate of return. Moving ahead, talking about the next part. Okay, the same has been mentioned again, I guess. So we have an illustration now. So long-term price, the price is particularly 100 per unit. And then we have the anticipated inflation rate. The inflation rate is 5% per annum. For a project, that means we are going to have a new machinery. New machinery which is going to be loan financed. That means we are going to get it financed just like our cars. That we have that finance system available now, that every year we are going to pay certain kind of installments just like that. Now, talking about the next part, what we are saying that there are going to be 90%, let us say we have whatever our sales are being like 100%. Out of that, 90% are being realized. That means goods are sold and money is received. And rest of the 10% are being carried forward to next year. Okay, that means if you have made a sales of like 100 lakh rupees, 90 lakh rupees will be realized in the same financial year, whereas 10 lakh rupees will be realized, the payment will be received in the next following year. Now over here, there will be a table totaling 352 lakh rupees over 10 years with investment of 1012 lakhs. That means there is going to be an inflow of 352 lakh rupees you are going to get for next 10 years. If you are going to invest like 1012 lakh, and this is going to be your return. Now, what are these in periodicities going to tell you that the rate of return is 16% per annum. Now, let us have a look at the illustration. Do remember the sales of 100%, 90% is being realized in that year, and we are going to have the 10% in the next year itself. Do remember, in this illustration, they told us that yes, it is going to be there for 10 years. Moving ahead now, talking about, I'm going to hide myself now. Now we are going to focus on the question only which has been provided over here. So my dear students, do look over here very much carefully. These are number of years which have been provided: 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. We are going to take it for like 10 years because our investment plan is for 10 years only. Now over here, the output which has been produced in the very first year, the output which has been over here. Okay, this is cash flow model for, again, we are discounting it. So 6 is our output. Next year, the output is 22. Then 35, 35, 35, 35, 28, 12 and 5. Apart from that, now what they are saying that receipt from trade debtors, the money which you have received is 540. This is particularly my total inflow. That means the money which we have received over here so far is 540 lakhs. Okay. And apart from that, down payment, see what we are doing over here. Let us understand the part which is there properly. So this is the down payment which you have made to the machinery supplier, that is 150. And every year we are going to pay certain installments. Why? Because I have mentioned over here that it is going to be a loan finance system, right? So 150 is going to be our down payment, and now every year we are going to pay certain amounts to that person. Now, in the year of down payment, definitely there is no repayment. There is not going to be any repayment. Apart from that, you still have made, now we are talking about the outflows, other payments which you have made in form of salaries or taxes, that is 12. Total outflow is 162, and over here total inflow was, nothing, because we have just made our set. In spite of that, what we have done, we have made the payment to the machinery supplier. Now sir, the total outflow is 162. The logic being, we have made 12 lakh rupees of salaries, and we have invested like 150 lakh rupees of our money into the machinery itself. So net is going to be minus 162. Minus is our 162. 150 lakh rupees has been paid to machinery as a down payment and 12 lakh rupees of salaries. Now what company has done, from where these 150 lakh rupees have arrived, from where you got these 150 lakh rupees is by issue of shares. Financing activities, right? Financing activities, we have issued shares, because I told you earlier also, we need to plan a lot of things, right? Every time we must be planning a lot of things, and we are going to ascertain that how we are going to have this 150 rupees. If that is, available with those shareholders, or you can say the promoters of the company, they will be giving it as 150 lakh rupees will be taken from them against the issue of shares. As I have mentioned over earlier also, that sourcing of funds through share issue. So the money will be given from share issue only. Apart from that, the rest of the loan which is over there is 862, because see, I have mentioned over here that the machinery cost like 1012. In 1012 minus 150 is what we have made a down payment, and the balance is 862. So 862 lakh rupees is going to be my loan amount, and this loan amount now will be financed, and this will be paid in installments. Okay, that's great, sir. That's nice. Understood? Yes, please. Now, moving ahead, understood. Now we have the cash balance of 850. Let us leave it. Let us leave it, because cash balance is something when we are going to use it only in the situations being like when we are going to suffer losses. Or else we can also consider this cash balance right now. Logic being, we are also going to find out that how much sound our company is. So there are only two factors where we are going to focus right now. The very first is profitability, and the next is the soundness of the financials which are available with us. Now see, in the next year, in the second year, what we have achieved, we have made a sale of 540 lakh rupees. And after that, the 540 lakh rupees is going to be our total inflow. This is our total inflow, the total sale which we have made so far. Now, the units were number 6. 1 unit is equivalent to. We're not going to consider first of all the per unit price, because it's being like cash flow statement and we don't need to pay attention over there. So moving ahead, now we are going to talk about the expenses, right? This is particularly our total inflow. That means how much inflow is over there from various activities itself. Please do not consider 6. It talks about only the number of units which you have manufactured. Now, talking about the money, we are talking about the outflows. The outflows are 100 is the loan prepayment. The loan which you have taken over here against the machinery is required to be repaid. I'm talking about the loan which is over here, right? 862 is my loan. So we need to pay those loan installments, sorry. We are going to pay them in installments. Got my point? See now, whatever money which you have taken over here has to be repaid, and if you are going to calculate each and everything, here comes 862, which you have paid so far in the 8 years only. In the very first year, you have made down payment, so there is not going to be any installment for that. Talking about the next part, you have made payment to the creditors 435. After that, interest is over there at 70. That may be from creditors, that may be from the rest of the bank loans which you have taken, and other payments of 85, including salaries and taxes which you have paid so far. So totally your total outflow is 690, whereas the inflow is 540. Still your company has incurred losses. The losses are there of 850 lakh rupees, and again now you have what we are going to do. We are going to use it. We are going to pay this money from the cash balance which we have, and after that the cash balance which will remain with us is going to be 700. Right? See, now the cash is decreasing. If I talk about the initial parts when the machinery has been purchased, so these are not profitable for us. Now we are going to talk about the next part. We are going to talk about we are talking about just that how we are interpreting the financial statements. In the very third year, we have made a huge jump. The sale was 2139 lakh rupees. This is our total inflow again. After that, the loan repayment stands, because this is again an EMI which you have to pay. Payment to creditors 1745, interest payment 65, and after that other payments, it amounts to a total outflow of 2210. Whereas my inflow is 2139. Again we have losses. So again we are going to pay our losses from the cash balances. Now we have 629 only. We have 629 only. This is all about the per year figures which I am sharing with you. The same happens again in the next year. 3711 is going to be our total inflows, and whereas outflows are 3610. Now this year is going to be a profitable year for you guys. Why the profitable year? Because the production is higher. We have made payments. The interest payments are low. The payments have been made on time, and the other payments are even more. But still, due to higher turnover, we have achieved good profit. And again, we are going to contribute this 629 plus 110. Here comes your 739. Every year, this phenomena is being paid. Every year, we are following this part. So are you getting what I am trying to tell you, that we are going to understand each and every part? If I talk about the inflow, if I talk about the outflow also. Okay. So, it's very much important that how we are trying to understand. See, if I talk about any kind of cash flow statement, over there, it's all about what is the requirement of the client. According to that, we are going to mold it. If the person needs the this cash flow statement for working capital analysis or the financial structure. So we have just molded it as per our machinery purchase, because this has been designed in such a way that we are going to purchase our machinery. So that's why we are mentioning each and everything over here. So again 4059, and after that total is going to be 4010. A profit has been recorded for 49. We are going to add it over here. After that 4280 sales, right? 4280 sales are over there, and after that we have like 4074 is going to be our outflow, and again we are going to add it over here like 206. So if we are doing an analysis, that means if we are doing an analysis where what we can understand, if we are manufacturing 35 units, then only we can be profitable. Then only we can be profitable, my dear students. If we are manufacturing less than 35 units or at any point of time, because at a particular point of time the machinery capacity is very good. Now the machinery has started depleting, because over a period of 10 years, if you are using a particular machinery, the output is not going to be that much. Output is not going to be that much. So after that you have manufactured like 28, 12, 15, whatever is given into the illustrations. Now what is the total revenue which we have? See, let's make a total over here. 4496, and after that 4192, then it's 3887, now 3810, 1950, then we have 1933. Apart from that, why we are doing this cash flow? Can you please tell me? I'll tell you, I'll tell you each and everything. So again we are contributing to this, again we are contributing to this, right? So now what we are going to analyze, now what we are going to ascertain, first of all, that what was our intention, right? Now what they are saying, that net inflow is going to be 352 lakhs over 10 years. If you are going to invest 1012 lakhs, right? What we have invested over here, see, 150 lakh rupees is going to be was my down payment, and 862 lakh rupees was our loan repayment. That means yes, 1012 or 1012 lakhs is straight away my investment. Agreed, 100% agreed. But is it like that we have achieved 352 lakh rupees of outflow using this machinery or not? Yes, we have. Right? If we are going to calculate this along with the losses, along with the profits which we have so far covered, that means inflows and outflows, yes, we have achieved 352 lakh rupees of profit, or you can say inflow, using this machinery. And apart from that, what we are going to check next, we are going to check is that in the last 10 years, we have achieved a total inflow of 26055 lakhs. Right? And just from the receipt of trade debtors, we have received 25933. Sir, what is this 122? 122 is over there from the machinery which you have purchased over there in the first year. Now the same has been sold as a scrap, and you got it like 122 lakh rupees for that. Okay, we got it like 122 lakh rupees for that. Yes, because the life of the machinery was 10 years. They told you, yes, that over a period of 10 years, you are going to have 352 lakh rupees. It's going to be your net inflow, and it is there. It is there. Okay. Got my point? Yes, please. And every year, whenever you are selling this, whenever we are doing this, so what we have done actually, we have just tried to interpretate the cash flow statement. We have just tried to find out that how much money which we have received, what was our loan, what was our every year installment, or you can say repayment, how much sales were made using that machinery, from where does the money came from. Over here 150 which was required over here, we have paid it using the issue of equity shares. So it's all about interpreting those financial statements, that how the particular organization is working, from where the money is coming, from where the money towards where the money is going. So that is all about the interpretation which is over here. Getting my point? So it's all about the interpreting that financial statement, or you can say cash flow statement, in order to ascertain, in order to analyze the financial performance of a company. It's all about analyzing and interpreting the financial statements in such a way so that you can come to know about the profitability and the financial soundness. If I talk about the financial soundness of this company, see, our cash balances at the start of the year was 850. Now it is 1364 after 10 years. So can I say the company is financially sound? When we have started our businesses, there was a loss of 162 lakh rupees, and over the years it has been turned out into profit slowly and gradually, and now at the end we still have 352 lakh rupees of profit as what we have predicted so far. Got my point? So looking at the machinery part, how much payment was there, how much EMI was there, it's all about interpreting them. How much from where did we got our down payment? If machinery has been purchased after 10 years, that has been sold, right? That has been sold, and after that, moving ahead. Yes, after that, moving ahead. How much we have achieved, how much were our sales, and once we have sold the machinery, each and everything can be analyzed or interpreted from the financial statements. That was just an illustration to show you guys that. Okay, and apart from that, sir, this interest payment 6538, this has also been decreased gradually. That means the loans which we have taken, we have been repaying them on timely basis. There were no late payment charges or anything like that. The interest has been decreased. And apart from that, other payment, that means 295, 497, 558. So this has also increased because sir, company has done expansion. No. That means our inflow, that means the inflow, the money which we have received, that has been, right? If you are receiving money, if the sales are more, definitely you have been expanding. Right? You have been expanding. That means the business is growing. So one can easily identify, yes, the business has taken a huge jump from year number 3 to year number 9. And after that, yes, this sale was only like 1,004 lakh rupees, and that has resulted into losses. So, one can easily ascertain that if you are manufacturing like 28 units, you will earn a profit of 67 lakhs. If you are manufacturing like 35 units, then it is going to be good. So, there is one more thing, that only sales is not everything. What I am trying to tell you over here, that only sales are not going to make everything. If you have good production, it does not mean that everything is going to be alright. See, over here we have like 35 units were being manufactured from year number 4 to year number 7. Still, in year number 6 we have got, and year number 7 we got 304 profit, and over here is 206. But in year number 5, in spite of having 35 units, we got only a profit of 49 lakhs. The production was same, but the profit has been decreased, or the inflow has been decreased. Why is it so? Because of these other payments which have made a huge jump over here, right? The payment of creditors which we have made over here, they have made a huge jump. That's why the inflow has been compromised. So it's not about just having a good productivity, that means you are financially sound. No. Interpreting the financial statements in the right way is going to help you, your staff, your members, your employees, and the various stakeholders for investment purpose and for the purposes of their job as well. Now let's cover some theory. The financial statements is all about evaluating the relationship between the various components of financial statements so that we can have a better understanding of the firm's position and performance. Looking at this financial statement, or you can say cash flow model, we can easily find out that how much outflow was there, how much inflow is there, how much interest payment is there, what was the down payment, how much every year installment we have paid, every year loan repayment, how much has been made, and after that, how far the financial performance of the company has been impacted, that has been impacted in a negative way or a positive way. Okay, moving ahead, my dear students. So over there we can easily identify now that what is our financial strength and what is the weakness. If you are properly, closely interpreting the balance sheet, the profit and loss account, and so it's all about, that means that the information which is contained over there, if you are taking it up to a relevant level, if you are trying to understand, and if you are trying to highlight the proper relationships, as we have mentioned over here, that the relation of the interest payments which have been decreasing every time. Why they are decreasing? Because every year we have been paying something. In the first year that was 70. Why that was 70? Because out of 862 we have paid only 100. Next year interest was only 65. Why? We have paid 105 now. Every time if you are paying something, that is directly proportional to interest, because we got something on finance. Now after that, the higher is going to be your sale. 550 is your sale. That means 435 is what your dues are required to be paid to creditors. That means it's very simple. Very simple. The proportion of output versus input. If you are going to manufacture some outputs, definitely you would be needing the inputs for that. Again, if I talk about 2139 is our sales. Now we have made a payment of 1745. That means our inputs are costly. We need to work upon this. The inputs which we are getting over there as 1745 lakh rupees, we are able to convert it only into 2139 lakhs. Apart from there are other overheads as well. Right? So one can draw various interpretations looking at that part. It's all about arranging the information in a proper way so that you can correlate the parts, the components in such financial statements. And the various areas where such financial performance is required, financial performance analysis is required. The very first is working capital, financial structure for a particular activity, or you can say for the profitability as well. Okay, moving ahead, my dear students. Now let's talk about that why we need this financial performance analysis. This is of different parts we understood, but why we need it? That is the first question which came over here. Why we need it? See, first of all, the importance or the significance that varies with the interest of the people which are involved. Somebody must be needing it for like giving loans. Somebody must be looking after the financial statements in order to invest, or else somebody must be giving you a kind of a machinery on hire purchase or anything like that. Or employees, the perception of employees are different. Because they would be needing more bonus, more salaries. The perception of a particular government is going to be different because they would be needing taxes. The perception of the bankers, they are going to be different because they are going to give you money, right? The perception of shareholders, that's again going to be different because they are going to look after that how much dividend you have given so far in the previous years. So significance varies with the interest of the various parties which are involved. Still, the parties which are involved are trade creditors. Because if I talk about the creditors of my company, everybody must be interested in my liquidity, that how much money we are holding, and meanwhile in how much time we can pay. So looking over here, still we have losses, but we have made payment. We have a strong cash balance and we have made payment on time. We have made payment to everybody. The organization was suffering losses, see, but still we were making payments. They were making payments to everybody. Okay. Understood? Moving ahead, talking about the next part. Now we have bondholders, the people who are interested in our cash flow, our capital structure, because they are going to give us funds. So they are going to have a proper future profitability, that it's okay. Whenever a loan is given, that is not given for a period of like 10 days or 20 days. That is given for like 10 to 20 years. So they need to check that it's okay. Today we have given a loan, but does the firm or the organization has the capability to remain profitable for a period of like 20 years? Because over here, what we can see that the inflow is decreasing. Now at this point of time, they have again losses, and these losses are going to increase. Now this is the exact time that they are going to buy a new machinery over here. That yes, again they have issued shares, they got 150, and now they are again going to buy a new machinery. Right? So far what they have earned from the machinery is 352 lakh rupees. Okay. So it's all about analyzing. One can also analyze being like that, how much does the machinery cost, including the machinery and that part which you call as like interest part, the down payment plus machinery, or the loan repayment, and how much we have earned from that machinery itself. Apart from that, the investors, they are also interested in the profitability. They are going to check that where you are standing right now and what are the expected future earnings. Then only a person is going to invest in your company. If you are going to tell me that yes, today we are doing good, but we don't know that what is going to happen after being like 7 to 8 years, I'm sorry. If you are not much sure about that. I'm sorry, nobody is going to invest over there. Apart from that, the management that is also very much interested in the financial performance analysis, looking forward, because they need to find out that how much return they are getting. See, over there it was right that periodicities of these data make a return of 16%. That how much is particularly our return of income, right? How much return we are getting on a particular investment, and what are the various opportunities which are available at this point of time. See, over here the organization's cash balances, they are increasing. So what are the next opportunities which we have? What are the various opportunities which we have? Right. So everybody would be interested. Whosoever is going to give you money in any way, they are going to be interested that how much opportunities do you have, and what kind of future expectations in terms of profitability they can expect. Right. So, okay. Got it. Now the types of financial performance analysis. So see, over here we were talking about the what are the various areas. Now we have types. What are the various types? If I talk about a particular financial analysis which is being carried out over there, right, that has been categorized into various categories. The very first is on the basis of the materials which you are being used, and the next is modulus operandi. That means analysis over a period of time. Okay, analysis over a period of time. Analysis over a period of time. Got it? So at least we are going to analyze the things over a period of time, taking into consideration the horizontal part and the vertical part as well. Now, first of all, let us talk about the material used. See, on the basis of the materials, which said materials means inputs. Not inputs. That means the materials or the components which we are using in financial performance. So there are two ways. The very first is, that means the people who are over there outside your organization. So particularly they don't have any kind of let it be like the government, let it be like the people who are going to invest in your company, right? So they are also going to see if there is a particular person who is investor and he is looking forward to invest in your company, right? He does not have the access towards the books of accounts which you do have. He does have the information he does have the only information which is publicly available, right? The half yearly results or the quarterly results, or you can say the yearly results. He has got those results only, and the analysis carried out by a person who is outside the organization, who are outsiders of business, is known as external analysis. And this is in fact not absolutely correct, because they have only published financial statements for analysis, which serves only few purposes only. Just like that, they are going to have balance sheet, financial cash flow statement, and profit and loss account. Using them, they can analyze. Apart from that, the internal analysis is particularly carried out by the executive and employees of the organization. They have access to the books of accounts and the other information whatsoever is related to the business. They know everything about the business, everything. They know about what kind of transactions we are doing. They know about what kind of transactions we are going to do in future as well. Because an insider knows everything about business, right? An insider knows everything about business. And the same internal analysis can be carried out by government also, by government officials. In case, let it be like a particular raid, inquiry, inspection, investigation has been ordered by government. So they are going to sit in your company and they are going to have access to each and every books of accounts and papers, and the information which is over there related to your business, whether that is within your company, within your organization, or that is available outside your organization. They are going to check everything. Let us say if there is a case of tax evasion or anything like that. Apart from that, the next is modulus operandi. That means can be analyzed over a period of time. So what you are going to do now, you are going to have the very first is horizontal analysis. That means a number of years are going to be reviewed. You are going to review your financial statements over a period of years. Just like over here, what we have done, we are doing an analysis on the basis of years. Year number 1, 2, 3, 4. How we are performing over the number of years. Right? How we are performing over the number of years. That is all about the financial performances which are there. Right? So this is horizontal analysis. This is horizontal analysis. What you are going to do, you are going to compare your figures with the standard or the base year, and you are going to find out that what is the change over there on a per year basis, just like we are preparing our financial statements these days, right? So we have the current year figures, then we have the past year figures, but this horizontal analysis is much more elaborative as compared to that. We take a base year, being like I've taken a base year of the year 2000, then I'm going to like 2001, 2, 3, 4, 5. Now this is going to be my base year. In 2001, I'm going to compare it with year 2000. In 2002, I'm not going to compare with 2000. I'm going to compare this with the base year again. Again with 3, I'm going to compare it with base year. Again this with this year. Again this with this year. So this is my horizontal areas. So why we are doing it? This is particularly in order to find out that what is our weakness, which year was weak, what was the reason, and what are the various areas of our strength. The people who are changing their strategies in every year, so for them it works, that how this strategy is working. And this is particularly also known as dynamic analysis. Dynamic analysis. Now the next is all about the vertical analysis. Now vertical analysis does not include the total financial statements. They just include the various items of financial statements on a particular date. Let it be like on 14th of February, I'm going to find out. Right? See. Okay, let it be. Horizontal analysis talks about the same company only. That what we were doing last year versus what we have done in this year itself. Now the vertical analysis talks about the performance analysis of my company with competitors, right? We are going to analyze, or you are saying that we are going to compare with competitors. We are going to compare with competitors. That means, let us say my company is over there as X, next is my company Y, and then we have my company Z. Then we have my company Z. All of them are competitors. So what we are going to do, we are going to analyze these things in such a way. So let it be like, just like we have Bata, we have Relaxo, and then we must be having any other option. Or let it be like that we are comparing in such a way that we have Puma, Adidas, and Nike. So Nike and Adidas. Puma, or let it be like Sparks and Nike, right? So I mean, this is the analysis. If you are doing such kind of an analysis, this is known as vertical analysis, because you are not going to pick up each and every component. You are just going to pick up the sum of the items of financial statements on a particular date. We are going to compare ourselves with the competitors, that how they are performing versus how we are performing these days. Comparing the performance of several companies in same group or division or departments in the same company. Okay. So let us say if I talk about that, what are the sales of Puma versus what are the sales of Sparks, versus what are the sales of Nike. So we are going to compare this with the sales department of the competitor. Purchases, we are going to compare it with the purchase department of the competitor. That means how they are working versus how we are working. Okay. Got it? Then this is also known as static analysis, or you can say static analysis. Doing this with our competitors or the people who are over there working into the same industry as well. Okay. Got it? But do remember, this is done for a particular date. At a particular date, this analysis is being carried out. Now, these are various methods. These are various, you can say, the types. But how one can do financial performance analysis? How that is done? How one can identify that whether the company is performing good or not? Whether the company is performing better or not? Whether the company is turning out to be financially sound or not? How one can identify that? That is again one of the major problems. Okay, so now we have that part. Yes, please, go ahead. So what are the various tools for financial performance analysis? Right, there are a lot of accounting techniques which you guys must have covered so far. When it comes to your accounts, you have covered each and everything. Sir, what is the which book you are referring? I'm just referring to the module which has been given by the institute. We do not refer anything else in our classrooms. So accounting techniques, I'm not going to pay a lot of attention over there. Right? For comparison, we have like common size financial analysis, trend analysis, fund flow analysis, cash flow analysis, CVP analysis, ratio analysis, value added analysis. Right? So each and everything is going to be there, which is going to help you with the financial analysis, that how we are working, how we are performing, or let me correct, financial performance analysis, how our financials are performing. Okay. So first of all is ratio analysis. You guys know about that every time. This was, I still remember when I was in my 11th, the same chapter was over there named as ratio analysis. There were number of ratios which are over there. Ratio is all about the numerical expression of two components, right? And we are going to have those components being like debt equity, sales to COGS. So a lot of ratios were over there. And still we have been like ratios to calculate the liquidity. We have ratios to check out our leverage system, debt equity. We have ratios to check out our profitability, and we have ratios for our activity itself. So over here, if I talk about liquidity ratio, that will straight away tell you that availability of cash to pay debts. That means we are going to analyze the cash which is available with the company itself, that how much is the ability of this company, how they are going to pay cash. Okay. Moving ahead, apart from next is the capital structure or the leverage ratio, which is made available being like that its ability to pay the long-term debts. Its ability to pay the long-term debts. That means the bank loans or the long-term loans which you have taken, will you be able to pay them? The next is profitability. Its ability to generate profits. Its ability to generate profit, and how they are using their assets, how they are controlling their expenses, and what is the kind of rate of return which they do have. And next is activity ratio. Activity ratio means efficiency ratios. In order to check out the efficiency, that how a particular asset or the resources of the company are working. Right? Right. So moving ahead and talking about the next part, which is all about like common size financial analysis. Now common size financial analysis is being like a vertical segment. Just like we were talking about the vertical segment over here, the vertical analysis. That's right. Likewise, what we are going to do over here, we are going to take the total assets and total liabilities as a part of 100%, as a part of 100%. Now we are going to talk about each and every expense or each and every income which has been gained or earned so far. Oh my God. Right. So what we are going to do over here, we are going to compare each and every single item with the total number of assets or liabilities. If that is an expense, we are going to take like total liabilities. If that is an asset, we are going to take the total assets. Right. So now moving ahead, talking about the next part. So totally what we are going to do, we are going to take the total over here. Let us say we have some different kind of companies, ABC companies are over there. So what we are going to do, we are going to take the total of the assets which are owned by these companies. Just like if I talk about, if a particular company is saying that we own 25% of the market, how that can be said? Just because of the total cars which are, likewise an automobile company saying that we capture 70% of the market, how can they say that? They can only say that if it comes after a particular analysis that out of 100 cars, 25 cars are sold by this particular company, right? Then only. So the common size ratio is for each and every item in the financial statement. So likewise, if I'm going to tell you that my net income, or let it be if my profit is this much, right? In my profit, how much contribution is given by rent, how much contribution is earned by the sales, how much contribution is owned by the interest on investment, how much is by the dividend itself. So what we are going to do, we are going to take the common size ratio is currently calculated by the item of interest. That means the item, let it be like rent, sales, interest, dividend, and the reference item. That means the total profit. Okay. So let us take an example of inventory. If I talk about inventory, so to which group does inventory belong? Is it a total asset or is it a liability? So it means asset. So we are going to take whatever the group, whatever the part from where this item belongs, we are going to take a total from there. That means inventory is going to be calculated from total assets. So the common size ratio for inventory is going to be inventory upon total assets. inventory upon total assets. So we are going to express this ratio in such a way. Okay, got it? So income statements, if I talk about these income statement items, we are going to have total revenue. This is my income, right? Apart from profit, you are going to take the total revenue which you have received. You are not going to take profit. If I talk about any expense item, you are going to take the total expense. If I talk about any kind of balance sheet item, you are going to take the total asset part. Okay, sir, if that turns out to be liability, definitely we are going to take liability now. Just like that over here, if I talk about the revenue part, we are going to take the total revenue as mentioned over here. For the income items, for the income statement items, we are going to take the total part is going to be not total assets, it is going to be total revenue. Right, total revenue is 70134. So if I am going to calculate the cost of goods sold, that is 44122. That means this is my COGS. How much is my gross profit? Gross profit is this much. That means 36.9%. And other expenses is 531. So each and everything is going to be compared with this block. That means this is known as reference item or the total of that particular belonging group. Got my point? For revenue items, it is going to be total revenue. For liabilities items, it is not going to be there being like we are going to calculate a ratio, and that will not be calculated being by liabilities. Everybody used to look after the turnover or the profit or the asset size of the company. So in that situation, there will be only two heads being like the total assets or total revenue. You are going to take any one of them as the base itself, and after that the further calculation is going to begin. Got my point? Getting my point or not? Moving ahead. So just like that, we have over here like different types of incomes are over there. Right? Now we are going to take the net income over there, not profit, my dear students. Do remember this part. So again, it's income, interest expense, provision for taxes, and net income. Over here, what is my total revenue? Total revenue is 70134. So the base is going to be total revenue. Total revenue is 70134. We are going to take this as a base, and after that we are just going to calculate the percentages, and this is going to be your answer. Common size. That means we are going to bring each and everything under a single common umbrella, and that will be dignified, or that will be depicted in form of these percentages or fractions. So for percentages or fractions, only percentages. Right, we are going to take the total revenue over here. The base can be only two of them. That can be total revenue or total assets. Do remember this. If I talk about common size ratios. Okay, common size financial analysis, or we are talking about these kind of things. Right. So whatever the item is going to be beyond that item, there is going to be a reference item, and reference item can be the total. Shall be, not can be, that shall be the total of both of the total of the particular revenue part or the asset part itself. Got it? Understood, my dear students? Moving ahead, talking about the next part which we are going to discuss today is, okay, the next illustration which we have over here. Now here comes the balance sheet, and we are going to draft a common size balance sheet. This is your balance sheet having a particular assets over on this side and having liabilities over here. Right? Now, belonging, from where does it properly belongs to? Right? Do remember, from where does it properly belong? So just like we have assets over here, so one base or one reference item is going to be total assets, and just like we have liabilities, so one is going to be total liabilities. So you told us being like whatever group to which it belongs, we are going to take the total as the reference item. So we are going to take this part as being it is the total, and after that we will take this as 100%, and after that we are going to calculate the necessary percentages over and above. Got it? And you will be getting these results. So this is all about very easy to calculate a common size balance sheet. Just like liabilities are over there, we are going to take this part as liabilities, and after that the normal calculations are going to begin. Just you have to convert them into percentages, that's all, nothing else. Okay. So that means, but we are going to, refer each and every financial statement item, or you can say, and after that we are going to fix some kind of absolute values to them. Absolutely right. Okay. And why we are even doing this? We are just doing this to have a proper comparison to other firms. See, comparison to other firms. If I talk about any other company, and that company does have an asset base, you have an asset base 39985, and another company which is available over there that does have asset base of 399985, that is even 10 times more than you. You cannot compare them. You cannot compare your company with them because they have 10 times better asset base as compared to you guys. But if we have molded it into this phenomena, that means it will be easy to compare. Percentages are easy to compare, whereas if I talk about the numericals, it will become really difficult to compare with those numericals as compared to these figures which are laid down in percentages. It will be very easy. One can compare with some kind of odd companies as well. Did you got my point? Yes, please, my dear students. Moving ahead, talking about the next part. Now, the next is cross-section analysis. That means the comparison between companies. Common size financial statements, as we have mentioned. So what we are going to do, we are going to compare the multiple companies at the same point of time. And it is very much helpful whenever this asset or the liability part, or you can say the strength or the financial position of the company to whom you are comparing, that is different in size altogether. So what you need to do, first of all, sir, if I talk about, okay, now I have one question in my mind. Yes, please. You told me that we are going to compare this with other companies. Which company will be taken as a benchmark? Or which company will be taken as a base company? The company which is performing best in its industry is going to be your base company or the benchmark. You are going to compare a firm to the best performing firm in the industry, that is going to be your benchmark, and you are going to take that company. After that you will start comparing. Right? That is very easy. Everybody used to, so just like my parents used to do when I was a child, that they used to compare my marks with the topper of my classroom, and I was unbelievably, I couldn't even stand with him. But still they used to compare that. He was scoring 98, I got like 72. I was scored like 78, 87. And he was like 99, 92, 95. Oh my god, the comparison, there was no comparison. There was no comparison. But still, they were having certain kind of, common size. Because we have those common subjects, right? And they can set that person as a benchmark, and after that they will start talking about the comparisons, and they will start criticizing. Hey, why did you study? Padhta hi nahi hai, right? Things are like that. So my dear students, moving ahead, talking about the next part, it can be used to compare the multiple companies at same point of time, right? So whenever we are when comparing companies of different sizes, a firm, if I talk about the total industry which is available, so ratios are what we are going to calculate for each and every firm in the industry. Do remember that. Everybody is comparing themselves with the concerned ratios as well. Okay, where your firm is standing right now. So if in a particular industry, I tell you, right, if I tell you that yes, A, B, C and D, there are 4 companies and B company is performing best. So we are going to have this company as our benchmark, so that we can find out that where we are standing right now. A, C and D companies will find out that where they are standing right now, where the maximum expenditure lies, right? How much accounts receivable are there, how much if I talk about how much inventory base is taken up by them. Let us say the company which is best, they are taking up their asset base like they are taking up their inventory like 42.9% of assets are their inventories, and whereas when it comes to us, we have only 20% of inventories. Right, their total current assets, their working capital, if I tell you, that is 93.9%. Right, that is very good. But if I talk about rest of the things, it becomes difficult. It becomes crucial. Sir, can you please tell me one thing? Yes, please. Can you please tell me that how this total current asset, it is mentioned over there as 93.9? Yes. So you are going to take each and everything, right? Do remember, my dear students, it is very basic, and don't be such. Total assets comprise of both of them, current assets and proper plant and machinery. If you are making such kind of a comparison, do remember the above parts which have been mentioned over here, they represent your current part. They represent your current assets. These are a part of current assets which can be converted into cash. Do not take them as fixed asset. So if you are making a comparison and you have a question in mind that these two will contribute to 100% and above all three of them are going to be your current asset part. If you are going to make a total of all of them, that means the above three parts, that means your total current asset, and if you are going to make a total of both of them, that will embark straight away, that will be that the figure which will be given to you, that will be total assets. That is going to be total assets. Okay, moving ahead, talking about the next part. So what are the various limitations? Right, common size statements are over there. We can understand that yes, we are going to take a benchmark, we are going to compare them with the best performing company in the market or in the industry. Now, what are the various drawbacks? Is it possible to implement common size financial statements to everybody, to every firm? No, because every organization may have some different accounting policies. Right, you have adopted SLM method. They must have adopted WDV when it comes to methods of depreciation. You are preparing your books on double entry system of accounting. They may prepare their books on single entry. Right. So situations can be there, chances can be there, different accounting policies are there. Okay, moving ahead, and after that, even different accounting calendar years, or different financial years can be adopted by various organizations. Sir, Companies Act tells us that Companies Act is only applicable to companies. I'm talking about each and every organization. So maybe there's a probability like if one organization is taking up their financial year from like 1st of January to 31st of January as per their year, we are talking about an international business organizations. So, and you are taking up like from 1st of April to 31st of March. So in that situation, comparison between companies having a common size financial statements, financial analysis is going to be difficult. If they are preparing their books of accounts on a single entry system of accounting, and you are preparing on double entry system of accounting, so that is going to be difficult. And when it comes to particularly if you are adopting this within the same country itself or within the same state, it is going to work. But when it comes to comparing them with the cross-border companies, it may sound difficult because of having a different infrastructure, different accounting policies, different financial years. It may have, the comparison may not be that much effective due to these limitations. Okay, right. Now the trend analysis we have over here. The trend analysis is going to be the last topic for today, right? And over here, what we are going to do, we are going to talk about just a single item or groups of item over a period of time. Just like we are going to take about like profit, COGS, and our taxes. So what we have taken items or group of items over a period of time. And after that, we are going to draw the conclusion regarding the changes in the data, and we are going to take it like 100th of that year. So what a group, and for that we have certain index numbers, and you must have heard about indexation in taxation. Indexation in your capital gains when you have covered taxation, that is one and the same thing which lies over here. Okay, so you are going to have the index number right now, and after that we are going to calculate it further, just like we are doing it in revaluation. So let it be like in 2020 or in 2018, the value was like 183 lakh rupees. And what is going to be the value in 2030? What is going to be the trend, right? In 2030, this is going to be my value. So that is all about the trend analysis. And for this, we are going to pick up few items only. We are not going to pick up each and every. Right? We are just going to pick up few items from that part, and after that we are going to move ahead with that. Got it? I can understand the class may be a little bit boring. It doesn't sound so, but it may be. It's okay. If it is, it's okay. But still, do remember that we are covering each and every aspect whatsoever is forming a part of your syllabus, and we are covering 100% of module. So that means nothing should be over there which comes out of your classroom. Okay. I'm sorry. That's all from my side for today. Bye-bye. Take care of yourself. I'll see you in the next class. Bye.